If you don't have net profits, there's nothing to mitigate. People can save 10, 15, sometimes 20 grand in self-employment taxes as long as.
Welcome to the Tax Mastery for Solopreneurs show, brought to you by Oakenshield Tax Advisors, where we've helped solopreneurs legally save millions of dollars in taxes by following our simple 7-step tax mastery framework. I'm Sam, and I'm here with Daniel Sleep, CPA, certified tax strategist, and the founder of Oakenshield Tax Advisors. Each week, we'll show you how to stop overpaying the IRS, keep more of what you earn, and redirect those dollars into building more wealth. A quick disclaimer though, every situation is going to be different. The advice that we share here today is not going to apply to everyone's situation. Make sure you consult with us personally. We're happy to help. So, Daniel, you want to tell us a little bit about what we're talking about today?
Yeah, so today we're going to be talking about the 3 S-Corp tax secrets every solopreneur should know. And that's going to include when it's the right time to be an S-Corp, what it requires, and then how to maximize your S-Corp election.
Let's go ahead and just jump into that first one, the first secret of when it actually makes sense and kind of at what level should a solopreneur really consider becoming an S-Corp.
Yeah, absolutely. Every situation is very different, and it's more about the business's situation, what they're dealing with. I would say normally anyone starting out should wait to be an S Corp until they start seeing their net profits go to a considerable amount. The reason why I say that is just a day ago, I had a meeting with a solopreneur. She was really honed in on, I know I need to be an S Corp, I need to get payroll done, I need to do all these things. And I asked, well, how much do you think you're going to be netting? And when I say net, that is your take home pay. That is what you are going to be subject to taxes to. And it ended up being only 30 grand for her. And honestly, it's better to just keep it simple. Keep it simple until the income climbs. And when the income climbs, you're able to take advantage of the tax savings that you can have with your S Corp. And this is, keep in mind, this is for service-based businesses too. If you're in real estate, definitely don't be an S Corp. So that is the other thing to understand is not every business should be an S Corp, but service-based businesses definitely should consider it unless they're looking to offset it in some other way. But for this individual, I told her, look, right now, you're going to be reporting your income on your Schedule C, which is included in your personal return. When you become an S Corp, you got to also have payroll. You got to have good bookkeeping done. And then you also have to do a separate tax return. So it better be worth it for you. And here's the other thing is if you're going to have losses, we had a company that had well over $1 million in revenue, but they were told to be an S Corp. So they got to be an F Corp, but they had losses. And it really just made it to where instead of them being able to offset their losses in an easy way, they had to have payroll. And for the owner, it just didn't really make sense. Why are we overcomplicating this with an S Corp with shareholder basis and all of these things you have to monitor as an S Corp? It just didn't make sense. And they quite frankly just weren't ready for it. The time when to elect is when your net profit is substantial. I would say closer to 50,000 or more is when you should definitely start looking at it. And then can you reasonably pay yourself a salary, something that is seen as reasonable to the eyes of the IRS? You can't pay yourself $5 in salary and the rest be distributions. That would be an abuse. Yeah. But if you're having losses, it's just not going to be the right time because the point of an S Corp is to mitigate self-employment taxes from the net profits. If you don't have net profits, there's nothing to mitigate. So that's the other point of that. And then additionally, lastly, I would say, make sure you're in the right industry. Like if you're going to be into real estate and doing a lot of paper losses through your depreciation of your real estate assets, do not be an S Corp. S Corp will mess up real estate ventures significantly. So be very careful about that. But you can isolate, you can separate. Maybe you have a business that does a service-based business side, and then you have real estate as a separate business. That's fine, but it better be worth it. Pay yourself a salary. I have a lot of, and I know of a lot of CPAs that are focused on real estate, and they are very anti-S Corp. which honestly is kind of refreshing because for the longest time, everyone was like saying, we'll do tax planning for you. And their only strategy was creating an S-Corp. It's a component of it, it's a way to optimize, but that should be a very generic strategy to implement. But the real strategy brain is knowing when and when not to implement an S-Corp election.
Right. And it sounds like, yeah, if you're doing it too early, it's not going to benefit you. Or if you're in the wrong industry, you're saying real estate. But
Yeah.
if you're netting over 100,000, is what you're saying, because then at that point, maybe you could pay yourself a reasonable salary of 70, 80,000, and then the rest can be, what is that called? Or how does it work? Like the
Yeah.
remaining amount you can.
Yeah, essentially, you want to assess a reasonable compensation amount. The IRS doesn't really give specifics, but they have had court cases. There was a realtor, for example, that was netting about 200,000 and he only paid himself a salary of 30 grand. And so when this
Mm,
went all the way to the courts, they determined you couldn't reasonably pay someone else that amount and then want to work for you. So they recalculated what they believed his salary should have been, and it should have been 100 grand. And so he had to pay additional payroll taxes, and essentially was abusing his S corp election, right? Even worse, and I've seen this, is I had someone come to me. He had two S corps, and neither one had payroll for himself. And this was
mm,
a red flag. We ended up parting ways, and I wasn't willing to take on the risk myself just because he had no books and he was netting over $1 million and had no salary. It's like you're asking for the IRS to pick you for an audit. It depends on, there's reasonability tests that we do and we assess, but ultimately you just got to make sure you're paying yourself a W-2 salary. You have to go through Gusto or QuickBooks Payroll or ADP or Paychecks and just make sure you're paying yourself something. Now, I've had situations where somebody has not done the S election. Let's just say, for example, they made 100 grand and they did the S election, but they haven't done payroll quite yet. Or maybe they haven't done the S election yet. And they're like, they really want to, and it's not too late. Well, you can do a late election and submit that paperwork to the IRS, but then we got to set up payroll. And if we have a payroll, let's say, for example, of 50,000 for that individual, they're saying, well, I don't have 50,000 in my checking anymore. I already used that money. And that's where we need to do what's called a paper check, but not cash it. So we do a one-time payroll where we show the 50,000 and we're just paying the payroll taxes. And depending, we probably want to include a good amount of federal and state withholdings if state is applicable. And then just say the net of that is like 38,000. And they're probably thinking, well, great, I don't have 38,000 in my checking account, or maybe I do, but it would wipe me out. Instead, what you can do is just not cash the check and just do a journal entry against your books. Now, this is where it gets technical and boring. I'll just let you know that we do this quite often, but it's very clean because it shows, okay, we're going to get a W-2, and because we don't cash the check, we're essentially just contributing that net pay back because we've already been taking out that money throughout the year. So this is a way where you can still be completely compliant that first year. And then ideally, you want to be taking an ongoing payroll throughout the following year. But there's a lot of ways you can implement the S Corp, but it does require a lot of responsibilities. And I think that's section 2, right? It's just like the responsibilities of electing to be an S Corp is you have to have reasonable compensation. You have
yeah.
that compensation has to be payroll, has to be W-2. Don't try to sneak around by issuing yourself a 1099 because that does not meet the requirements of the IRS. The IRS wants that to go through payroll. Someone could say, well, it's going to be subject to self-employment taxes, that 1099. Yes, but it's not going through the W-2 route, which is actually what is required. You technically can't be constituted as a contractor of your company. So I think to keep it simply put, just make sure your W-2, your income is W-2, not 1099, because that's really
Got
the
it. Yeah.
about it.
Yeah, no, I'm glad you said that. And you said we already actually jumped into secret number two, which was talking about responsibilities of an S corp that a lot of people don't realize, which is exactly what you're saying. The reasonable compensation and then paying yourself as a W-2 employee, not trying to sneak around like you're saying. So let's go ahead and just jump into the last point here, which is all about optimization, right? How to unlock the real savings as an S corp. So once someone becomes an S corp, ultimately how can they maximize the benefits in that position?
Yeah, so you want to make sure compensation that you have given yourself as a W-2 is not too high, because the point of the S Corp is to allow you to get a distribution that is free of self-employment taxes. So people can save 10, 15, sometimes 20 grand in self-employment taxes as long as, they're doing their W-2 at a reasonable amount, but that's big savings in itself. And then following that, you want to make sure if you're within threshold limitations to qualify for QBI deduction, which is a qualified business income deduction, which if you're making under that 175,000, you're going to qualify. Now, keep in mind, tax law always changes. This is 2025, so tax law changed pretty significantly this year with Tax Act that came into play. The other thing
Yeah.
is you can't do home office deduction as an S corp under the 8829 form. So a way around that is most of our solopreneurs, they do work from home. So, well, if I can't do the home office deduction, I'm just screwed. It's like not necessarily. You can still do it, but you have to do it through what's called an accountable plan. So essentially, the company is going to reimburse you for those home office expenses. Just make sure you don't abuse it. It's got to be, you have to have agreements written out, which feels silly because it's going to be between you and your company, which you are the owner of that company. But it's great to have as far as the documentation is concerned. And then lastly, I would say one of the most powerful anchors is the solo 401k. So with a solo 401k, you can definitely do a SEP. A SEP is going to be simpler, but you're limited to 25% as an employer contribution of your W-2 wages. So if you're making 50,000, that's only up to what, 12,500 that you can contribute. Whereas if you have a solo 401k, and granted, it does take a lot of cash flow, but you can, depending on the income amount of your W-2, you can cap out up to 70 grand. So I would say a W-2 of 50 grand, you're only going to be able to do 20,000 and or so in your employee deferral, but then an additional 25% on the profit sharing of your S corp. So you're going to
Mm.
be able to defer taxes significantly. And sometimes we have found that because somebody was, let's just say, for example, in fact, yesterday I was going over this with a solopreneur who was making about 400,000 and he has two kids and he was phased out of the child tax credit. Well, one of the great things was we were able to mitigate taxes by putting more into the solo 401k to lower that income. So not only did it lower his W-2 income, but it also, the profit sharing portion lowered his S-Corp income to the point where he could take almost the full amount of the $4,000 child tax credit. So not only was he able to lower his taxes through the deferral, but he also qualified for an additional 4 grand in tax savings, which is just great
Wow.
because people don't realize if you're in that area of your income being just a little too high where you're getting phased out of child tax credits and things like that, the deferring can have more benefits by getting you those credits back. So it's really important that you optimize and you see where's that opportunity to optimize.
Yeah. It sounds right now there's a lot of emphasis on social media. I see put everything into a Roth all the time versus you're saying that that's not always the best strategy if you can put it into a deferrable account. Is that correct? Or
Yeah, I'm a big proponent of Roths. I think they're great, but I think there's a time and a place. Another solopreneur was kind of tight on cash, and he was told by several people, hey, put your money in a Roth IRA. And he was just barely making it when he was, well, I either put money into some strategies or I put money to my tax bill. And when we really looked at it, really, okay, I get the Roth tax-free money later on, but that's not going to help you now. His objective was, I need to lower my tax bill for the next 3 years because I want to save up for a down payment on a house. That isn't going to lower taxes. And the problem is it doesn't, it just lowers your cash. So he put 7,000, he was going to put 7,000 away. I think even more than that. And his tax bill is nowhere gone. It's nowhere, it's not even not affected by the Roth deposits. So instead, it makes
exactly.
more sense to contribute to the deferrals. Yes, I get the argument of, yeah, but then he's gonna have to pay tax later. Let him worry about that later. He's not gonna
Yeah.
be able to benefit for the Roth in for another 30 years. His pain points are now, so let's focus on now. Here's the other thing. We can always do strategic Roth conversions later on. I've had clients where they've actually done 200 grand in Roth conversions and wiped out the tax effect through strategies of using real estate, through short-term rentals. I had another one do a simple fee donation. The deduction completely wiped out his 200 grand in Roth conversions. Now, simple fees are very high risk, so just be aware of that. But there are ways you can do Roth conversions without trying to necessarily time the market. Because I think financial advisors focus on timing of the market, saying, oh, if the market plummeted, that's the time to do a Roth conversion, which they're not wrong. But there's other things we can do to offset. If your business had large losses, that would be a time to do a Roth conversion because you're able to offset
Yeah.
losses against those conversions. So with that said, I suggest anyone who's looking to mitigate tax, focus on deferrals. The majority of these solopreneurs, this is their higher income years anyways. So why not defer and then either go into a second career as a real estate professional to where you can make those conversions or pay those conversions at a lower tax rate when you're retired. That makes more sense to me than paying a large amount of tax now and be cash poor because you're putting stuff into Roth. It's an argument that can, I am sure there's going to be someone that will say, well, what about this angle? What about that angle? Of course, there's always going to be exceptions. But I would say for the most part, if you're looking to mitigate tax, you may want to avoid Roths. And yes, you can do a backdoor Roth, you can do all of these other things. But if your income's really high, you're not going to be able to put away money in your Roth unless it's a 401k Roth, right? So for the most part, I would say defer. In fact, I want to say it was Ryan Bakey and his team, which are very knowledgeable real estate tax advisors, and they just say defer and then die. So they're not even really worried about the Roths because if you're deferring taxes and then you get a step up basis when you pass away, great, your kids don't even have to pay anything. So I would
No,
focus
it's
on.
great. Yeah, no, I think that's awesome. I think it's a great way to top things off too, because you started sharing some of these advanced strategies that you can use to offset that Roth conversion later and other things specifically to help with the tax burden now. And I think people need to hear that and to know that I know this is one of the more simpler strategies. And for someone who hasn't set up their S-Corp, I imagine you're here listening and hopefully got some great takeaways about these three different areas. We're calling them secrets, but being able to know when to elect, what it really requires of you, and then how to maximize it. So thanks for walking through those with us today, Daniel, and thank you guys for listening. But we are going to jump into more specific advanced strategies as we're sharing the 7-step framework that we do, which involves advanced things as well. So definitely stay tuned for next week. But yeah, thank you for joining us on the Tax Mastery for Solopreneurs show. If you haven't got the 7-figure playbook for solopreneurs to get all these advanced tax strategies, you can see our entire list. We have that available in the show notes below, or you can go to oakenshieldtax.com, where you can also book a call, meet us, or join our Tax Mastery for Solopreneurs course. Thank you so much for listening today, and let's save some money.
Yeah, let's do it.
All
Thanks,
right.
Sam.
Thanks, Daniel. Bye-bye.